If you're serious about building as a serial acquirer, if you are a high conviction person, the right time is now. Because there's a lot of anxiety amongst my readers and amongst your listeners about what if I don't have a thesis? Trust me, the anxiety is the same on the other side. Most investors underwrite the person, they underwrite the founder.
So take the leap. Don't be waiting for that perfect thesis, that perfect idea, because a lot of the time it's not the idea that the investors are investing in, it's the people behind the idea.
Exactly right.
Welcome to the RolyPoly, the podcast about all things roll-up. If the roll-up world had a maester, a keeper of all its knowledge, it would be today's guest. Prokofjev from RollUpEurope has become the single biggest source of truth for serial acquirers. 15 years in M&A, corporate development at Bolt, CFO scaling Threecolts, and he runs his own holdco in the Baltics. 3 years ago, frustrated at how little good information actually existed, he, his brother, and his wife built RollUpEurope, the newsletter, community, and bootcamp that basically everyone in this space now reads. This one's dense. We talk about why you should pitch investors before you have the perfect thesis, the fastest way to kill a roll-up, and his warning to AI founders about picking a fight with private equity. Let's get into it. Hello, Alex. Welcome to the RolyPoly. I've been following you and RollUpEurope for a long time now, so I'm really excited about bringing you on. How are you doing today?
I'm doing very well. I'm also very excited to be here, Dylan.
I really appreciate it. You know, at the end of every podcast episode, we ask the guest to name someone they think that should be on the podcast. And more than half of the previous guests have mentioned you. So I think it was about time. But for those that haven't heard about you before, don't know what RollUpEurope is, can you give us a summary of who you are and what you're working on at the moment?
Sure, sounds good. So I'm Alex. I'm 40 years old, originally from Latvia, but currently based in Switzerland. I, together with my wife and brother, set up RollUpEurope 3 years ago. What is RollUpEurope? It really is a community for serial acquirers. I'll go into detail what that means exactly, but you know, if your modus operandi is creating value by buying small companies in different structures, then you should talk to us. And today, our business includes three parts. There is the media part, which is the newsletter, which I guess many of your listeners will be very familiar with, which also has the conferences and the bootcamp. The second part, we obviously work with vendors. We help them promote products that are in demand by our community. And the third part of our business is the investing arm. So we back a number of the roll-ups and holdcos that we invest in. And how I got into this, maybe to preempt your question, is I worked for 15 years in M&A, so I'm an investment banker by training. And at one point, I stumbled into lower mid-market. I joined a small software roll-up. This was a recommendation from my brother, and you know, I haven't looked back since.
Yeah, from the research I've done, you've sat at almost every side of this world. You've done investment banking, like you just mentioned. You then did corporate development at Bolt. You were CFO scaling Threecolts, a well-known roll-up. And you own your own roll-up, your own holdco in the Baltics. What made you want to build RollUpEurope? What was the strategy? And on top of everything that's going on, why did you choose to make RollUpEurope?
Honestly, I think it was born out of pain and just inability to get information. Because I remember, 4 years ago, Pavel and I were both buying small companies, and that's incredibly painful. Because many of those companies don't have any disclosure, they don't have, any reporting, and then you're supposed to take them and diligence them and integrate them. And so it was just very difficult for us to figure out, how does one go about integration? How does one go about diligencing? And later, at the time, there wasn't nowhere near as reach of investor universe. And so explaining to people why they should back a roll-up of 1 million EBITDA businesses was incredibly hard. And so I kept bouncing around different conferences. I'd go to Web Summit, I'd go to Slush, I'd go this and that. But it was always either really big private equity firms talking about really big deals or like really early stage venture companies. And so frustrated with the lack of reliable source of information, frustrated with the lack of an open community where you can just go in and talk about those issues and map your path, we decided to create RollUpEurope in May 2023.
That makes a lot of sense. I felt the same. Other than RollUpEurope, it feels like the only way to learn about roll-ups is having a beer with someone that's done it already. You don't see online enough sources. There's not like an easy course to do. But now you've started, as well as RollUpEurope, you're doing your own bootcamp. So I think you're providing so much value to the ecosystem. But also, like when you do a lot of deep dives, so you're obviously analyzing roll-ups all the time. And does sitting above all of these deals let you see something or see things that the operators inside of the roll-ups often can't see?
Yeah, I think probably the most obvious one is that everything is much harder on the smaller end of the market than it is in the bigger end of the market. And that's where a lot of people who transition out of larger corporations and larger private equity firms miss. Because, I'll give you one very obvious example is in larger deals, the propensity to transact is a given. Because oftentimes, if it's a larger deal, 100 million EBITDA or bigger, it's typically brought to a market by an advisor. Everybody knows about this years in advance. And it's for sale because there's somebody selling it. And everybody around the table maybe hurling insults, but at the end of the day, it's just a game. A deal is going to happen. Whereas you go out there rolling up small HVAC businesses or small accountancies, and people do not know about your pedigree. They do not care about your pedigree. They do not care about the Stanford MBA or the fact that you work at Premier or anything like that, right? And that's where I feel like a lot of people who've spent their entire careers in professional services and are very good pitching to institutional investors, institutional buyers, institutional advisors, really struggle to build that rapport with the business owners who've only lived this industry and sometimes for generations. And then I think is the first realization, and that's where many of the serial acquirers are forced to radically change their style of communication and their playbook.
Yeah, okay, that makes sense. Quick break. If you run a group that's grown by acquisition, do you have live visibility on how it's performing financially and operationally? Or does that picture live in a spreadsheet weeks behind? That's what we fix at PMI Stack, consolidated reporting. Even if every company runs on a different system, we pull it all into one live dashboard. With an AI, you could just ask, financials, cash, operations, all completely customized to the KPIs that you care about. Plus, you can keep track of how each acquisition is performing against what you underwrote. If you want to see it on your group, go to pmistack.com and book a call. Now, back to the episode. A lot of the people at the moment are trying to work out which path is right for them. Search fund, holdco, independent sponsor, raising a fund. How should someone decide which model fits them?
Yeah, that's the subject of our bootcamp. So I'll do a bit of an advertising of the bootcamp. Basically, the biggest confusion stems from the fact that there are a plethora of structures, but these structures are built by the investors. And so there's a lot of jargon, and you just alluded to a couple of structures, but it doesn't mean anything for the people themselves, right? So if you have not worked in private equity, if you have not worked in roll-ups, it's very difficult for you to understand the difference between a buy and build and independent sponsor. And so what I would say is that always start out with your own objectives. Don't worry about the types of investors. Don't worry about the types of structures they're pitching, but write down a couple of objectives that you want. And I'll give you a couple of examples. The first one, I think, is, are you an operator or an allocator, right? An independent sponsor is kind of like a fundless fund where you pull together a capital, you're a developer, but ultimately the operational day-to-day running of the platform is done by somebody else. And the expectation is that you will end up creating a number of those platforms. So, I, having done a number of roles and having sat in sort of different places at the table, realized that I'm definitely more of an allocator than an operator. So, I could not be in a search fund where I'm buying a business and I'm running a business on a day-to-day basis other than my own business here, RollUpEurope. So that would be number one, right? Operator versus allocator. I think the second criteria would be, what is the time frame, right? Because holdcos have become very popular because of generational change, transition. You need to be very clear that you have 10 plus years to give to it, because there is definitely a J curve. And so if you'd rather do it for 3, 4, 5 years, then you should not do a holdco. I think yet another criteria is, how much autonomy do you expect, right? So are you okay having one single source of committed capital and never having to worry about raising, but then, you are under the control of that investor? Or do you want to raise from a consortium of investors like search fund style or VCs, right? And I would always start by writing down your own objectives. And of course, the most important, at least for some people, is, what do you want to get out of it at the end of the day? Financially, intellectually, is there a number in mind that you want to have, right? So start from that, and once you have your outcomes, then we can help you connect with the structures that really meet those objectives.
I see. So figure out sort of your objectives, and that could be a mix of professional and personal objectives that you have. You mentioned that you would say you're an allocator, for example, and some people are operators. Because you speak to so many aspiring roll-up operators, what would you say the mix is between how many of them are the more investor, M&A, allocator style, and how many are more operator?
I would say if you don't come from the investment background, it's very difficult for you to raise capital for an allocator strategy, because investors will want to see somebody who's done this before, who's set up teams. So probably 30% of people want to be allocators, but reality maybe only 5% can be. So the vast majority of people are operators, but obviously what tends to happen, as I've covered in a number of cases, where people do one platform, they really learn how it works, and they just replicate that success. So some people eventually become allocators, but at the outset, it's hard.
Okay, that's really interesting. Is this a good or bad strategy to start with maybe a search fund where you perhaps just do one acquisition, prove your thesis that you can professionalize and improve it, and then go into the roll-up strategy afterwards? Or is that maybe higher risk because at the same time maybe you get stuck with a bad business? Have you got any thoughts about that?
Sure. So I think one word I'll say about search fund community, I think it's great, is by far the most welcoming subset of lower mid-market. It's really much closer in terms of its culture to the venture community than it is to the private equity community, which at times can feel very insular and not welcoming necessarily. What I also love about the search fund community is that it continues to evolve. And so, as you know, there have been a number of very successful stories of compounding where a single search fund grows into a very large business. Asurion would be one example of that in the US, which has delivered, tremendous returns of more than 5,000x. So at the same time, search funds do have a limitation, is, the sort of aggregate investment that's available to you caps out pretty quickly. So we oftentimes see that, it's a 20 million euros or dollars of equity, which oftentimes just isn't enough to build like a sort of a larger roll-up. And the second thing is search fund investors don't necessarily like a highly acquisitive strategy because they don't like to provide add-on capital. So I would say a lot of search fund investors very active in the buy and build market, very, very active. But if you really anticipate at the outset the consolidation potential, then don't just limit yourself to search fund investors. Go and study the entire landscape. Who are the best capital providers, and start talking to them. And I think one thing that's very important is, when is the right time to talk to investors? I would say, if you're serious about building as a serial acquirer, if you are a high conviction person, the right time is now. Because there's a lot of anxiety amongst my readers and amongst your listeners about, what if I don't make the best first impression? What I don't have a thesis? Trust me, the anxiety is the same on the other side. Investors are very anxious to meet you guys. Investors are very anxious to get to know you and to help you arrive at a thesis. So I would say, if you're working inside a private equity firm, a corporate, and you're 6 to 12 months away from spinning out, and you have an idea, you want to test it, start doing this now. Because at the end of the day, most investors underwrite the person, they underwrite the founder. And so it could be that your idea is not a good idea, but maybe there's another idea, or maybe there is another team that requires a co-founder, right? But, unless you keep feeding them really bad non-starter ideas and wasting their time, they will be very happy to take your call.
So take the leap. Don't be waiting for that perfect thesis, that perfect idea, because a lot of the time it's not the idea that the investors are investing in, it's the people behind the idea. And of course, it has to come with a good idea, but ideas can change, not so much the people. Is that right?
Exactly right.
The next question I have here is, because you, of course, look at a lot of operators, you see, look at a lot of roll-ups and see how they do. Some go well, some don't go so well. When you look at the operators who do really well versus the ones who stall, what separates them?
Yeah, to answer those questions, I'd really give you two extreme cases. One case would be where people struggle to make an acquisition and their journey stalls or sort of stops, without even having started. And then on the other hand, where people burn a lot of capital, right? And that's something that we've written about a lot. The latter category under the roll-up of tomorrow rubric, right? And that's where it's very important that every acquisition is good. And I think there's a propensity by people coming from professional services backgrounds to interpret weakness in a business as a characteristic of the founder of the business and not so much the underlying economics. And what I mean with this slightly cryptic expression is that you look at a business and you think, oh, it's underperforming because the founder is dumb, because I don't like him, because I don't like his style, as opposed to it's just a terrible industry. And that's a mistake that people just keep making time and again, right? And which is why so many of those e-commerce roll-ups have floundered. So many of those roll-ups of high churn software have floundered because you cannot change the industry. So number one mistake that people make is throw a lot of money at turnaround situations. Unless you're a turnaround expert and you're able to step into a company and fix it, just stay away, right? That would be one. Another one is people tend to have milestones attached to certain revenue targets or profit targets or deployment of capital. Those are very bad milestones because revenue doesn't equal value. Even profits in the short term don't equal value. And so I've seen situations where people need to deploy and show a number of acquisitions and certain financials, and they just go and buy whatever, right? And that tends to lead to some pretty bad consequences. On the other extreme, we touched upon the search fund community. I think the latest data that's coming from Harvard, from Stanford, suggests that the percentage of search funds that end up successfully closing acquisition is declining. Whether it's 30% or 40% or 50%, it doesn't really matter because it depends how you count it. But I feel like there are a lot of promoters out there that are pushing this idea that buying a business and operating a business is very simple and it's an easy way for you to get rich. No money down, become an owner. I don't agree to that at all. I think buying a company is very difficult. And most businesses that are profitable and solid are also very difficult to operate, which is why they are so profitable and so solid. And so naturally, if you don't anticipate, if you haven't been through an M&A cycle, or if you don't have somebody by your side who's experienced in M&A, you're going to find it very difficult to go out there and buy it because every company will feel very risky or every company will feel very attractive. And so, which is a very long way to say that a lot of acquisitions, a lot of search funds fail because people fundamentally just don't have it in them to go through the full cycle of finding, acquiring, operating, and exiting in business.
I see. Yeah, one of our previous guests, Sam Turner, was saying how important resilience is as well, because there is going to be a lot of tough periods throughout the roll-up life cycle. So, and like you were saying before, you have to expect 7 to 10 years to be in that roll-up. So, yeah, that makes a lot of sense. And then inversely, what's the tell early on that someone's going to be in the top tier? How can you tell that someone's going to do really well in their roll-up?
I think the number one characteristic for me is whether the person is a high conviction person. So I always ask people, what's driving you? What's your life story, right? And at the moment, the fundraising for a lot of private equity firms is not going so well, and many VC and PE funds are shutting down. And naturally, people turn to this as a stopgap thing. And I think it's a mistake. A lot of stories that I've written about on the newsletter concern serial acquirers, where the underlying motivation is driven by something else other than money. Although the financial outcome is very important because that's how you stay motivated and motivate people around you, investors, vendors, your colleagues. And so in many cases, it's people's frustration with having to take orders and having to waste time on bureaucracy. So very obvious example, a lot of people are leaving private equity because they're having to compete for the same deal flow. They're having to do the same admin box ticking exercise. And in independent sponsor setup, where you raise on a deal by deal basis, you have a lot less bureaucracy. In other cases, we have people leaving established serial acquirers. They want to do things differently. Fana is a very good example. It's a firm that was established in 2019. Paul Barry, the founder of Fana, had worked in a number of testing and inspection companies, and he wanted to create something very different, right? He wanted to create something that's permanent, less integrated, and he also didn't want to necessarily report to a single private equity firm at the outset. And he's been very successful in that strategy. And 7 years later, he grew a business to almost 200 million pounds of EBITDA. But there has to be an underlying motivation, whether it's the right to win in the industry, where it's a motivation to prove yourself, as opposed to, I'm going to go into this because that's where the easy money is. Because I can tell you, lower mid-market is not where the easy money is.
I keep hearing this theme in all the episodes, that it's not as easy as a lot of people make it sound to be. Both on the investor side, they have a filter for tourists. And I think that's similar to what you're saying. You want people with real conviction, with motivations outside of just monetary ones. And so when someone is building up their thesis, or how early should someone think about the exit?
I would say it really depends on what you want to do, because the market, lower mid market, has matured to an extent where different preferences can be accommodated by different structures. And I would almost work kind of backwards, because in that sense, ask investors, what is the holding period? What is the target return? So I'll give you one very obvious example. There are a lot of buy and builds in the business services space, because if you look at the situation in the mid cap and large cap private equity, it's an AUM game. So those funds keep getting bigger and bigger and bigger, which obviously limits the amount of funding which they can spend on any given platform. So there are very few private equity firms that can invest 10 or 20 million to build a platform, because it's just not economic. And so one smart idea, which is really gaining traction, is to find an industry where you know is attractive to private equity because of the characteristics: recurrent income, mission critical service or tech or product, and you really create a platform that the private equity would be able to buy. And typically, those vehicles become interesting starting from 10, 15 million euros or pounds or dollars of EBITDA. And so working backwards is the question, okay, what does the industry look like? How many targets are there? How many of those targets are actionable? What is the average revenue and EBITDA of those businesses? And ultimately, if you're going to go and raise capital, what sort of return will investors like? Typical buy and build investors will want to get 3 to 4 times net in a strategy like that. Some will tell you they want more, but it's difficult to squeeze like a 10x or more. And so working backwards, you basically figure out how many targets can you realistically process in a year. And there are various examples, but typically the first year is quite slow. So you do 1 or 2 acquisitions. Maybe if it's a platform, you try to convince the CEO to stay on, but obviously as you grow along, then you're able to grow faster. But typically, what I've seen is anywhere between 3 to 6 years between the inception of the platform and the first acquisition and the initial exit. However, in many cases, the new owner will want you to either stay on for a couple more years or to roll over a significant portion of your equity, because obviously they want to see a further build of the platform. So to those founders that think that it's 3 years, then I sell and I walk away from private equity, it's usually not like that.
Have you seen often a pattern that people will exit their roll up, stay on for the years that they have to, and then do they usually do another platform, or have you seen that they typically become actual investors and just invest in other people's plays?
Yeah, like it's a very addictive industry because it's a cool community. I think search funds are probably farthest along, where a number of exited searchers either raise their own dedicated funds or just invest on a deal-by-deal basis. Within some of the high-profile exits in Europe and in this market, we've seen different trends. In Germany, we saw RCPA, which is a work safety roll-up that sold to Warburg Pincus 3 years after inception. The founders of RCPA recently raised a fund called Avon, which supports buy and builds across DACH. Just over the border in France, there's a very similar example with Builders Associés that is, partly built with the proceeds from the exit of Simago, a radiology roll-up, to Ardian in 2022. And then there's also the model of independent sponsors. So there are a couple of groups. There is Eros Capital in Sweden, who are behind Safe Life, a wholesale roll-up in Sweden. So they've built a number of platforms, and they have the capital to be able to incubate them. In Belgium, there's an independent sponsor called Around Partners, which also recycles capital to build new platforms. And I would say those are the type of people that I personally like to work with, because that they will keep thinking about new ideas as active investors or as passive investors. But obviously, some people just want to cash out and leave, and that's also fun.
Cash out, leave, go to Marbella, have a yacht. This might be a hard question to answer, because I guess it's like how long is a piece of string? How much money can someone make from doing a roll-up?
Yeah, it's very simple to answer this. If we just use a typical buy and build platform, which is what we see a lot, the vast majority of the exits would fall in the range of 3 to 5 times net. And so, if somebody is putting in 20 million in, and let's say the exit value is 80 million, and you get a quarter of that, so that's 20 million euros. But equally, we've seen cases which are much more spectacular. If you think about the Simago exit case, if you think about the Safe Life exit case, there the sale proceeds are in the hundreds of millions, and you as a founder of that get a very significant chunk of that. So it can be life changing.
Do you have like examples of common exit scenarios? Because what I think a lot of people find hard to wrap around their head is how much of that money goes to the investors, to the lenders. They all have to be paid back before you make money. And if you come in, of course, in most cases you probably see that the founders invest some of their own capital, right? They must have some skin in the game. Or is that not the case?
It truly depends. In independent sponsor universe, on a deal by deal basis, where you're raising against specific platforms, you are expected to put some skin in the game. It can be quite substantial, several percentage points. And if you think about 30 to 50 million raise, it can run into low seven figures. In a lot of the other buy and builds and also search funds, the financial contribution is mostly symbolic, because obviously there is expectation that initially you don't necessarily make a market level of salary. So that would be that. When it comes down to exit proceeds, it's very simple. So there are two types of structures. There is the VC sort of back roll-up structure, the AI roll-ups, and then there's the PE structure. And if we focus on the PE structure for a moment, investors will typically want to see a return to them. And, below that return, you don't get any proceeds. Whether it's 1.5 times or 2 times or 2.5 times, it's really optional. And then typically after they've realized their minimum return, there's usually a ratchet to you. And obviously for every bracket, say between 2 and 3 times net return to them, the incremental proceeds, a larger portion goes to you. But I would say, the range of outcomes that I've seen is typically anywhere between 20 and 30% of total equity proceeds is what the founding team gets.
Fantastic. Yeah. Have you noticed a big shift in where VCs have started to invest more in roll-ups?
Yeah, absolutely. I mean, the question, can you manufacture VC-like returns in lower mid-market? Absolutely. I think until now, it's been mostly prominent in 2 scenarios. One, either very long-term hold, where if you continue compounding and don't use a lot of capital, you can generate 100x and even 1000x. But I think it's not so relevant for VCs because that is a very long-term hold. And the second one, obviously, where you use very little equity and then you buy businesses mostly with debt, and then you aggressively try to improve them. And so we've seen an explosion of interest from VCs in a lot of white-collar industries, property management, accountancies. Part of it, very cynically me, is that there are a lot of software companies which haven't worked out. The companies that supposedly selling software to enterprise customers, and those customers just don't want to use that software. So instead of trying even more, they just buy the customers and buy the distribution. And that's a strategy that doesn't always work. But on the other hand, there are industries where genuinely the productivity is very low, and the company that's running at a 10% margin could be running at 30 to 40% margin. And if you take that margin uplift with a succession where owners genuinely want to live and they're genuinely willing to sell you books of business, and there's not a lot of transition risk, that can create very powerful outcomes for everyone.
Yeah, like for example, there's Dwelly has been, I think they got £70 million in funding, or £69 million in funding, which is such an awesome story. And what they've done is they've built internal processes through AI to automate a lot of their work. But then in addition, now it seems like, I think I read an article about this, that they're also unbundling that software, meaning that they're now selling whatever they built to other potential targets. This could be good because obviously it's an extra stream of revenue, but if later they want to buy companies that are already using their technology, then it's a lot smoother as well to integrate them. So I think that was a really interesting play that I hadn't really thought of before. Have you seen how is AI showing up in the serial acquirer world right now, and where do you think it's going to go from here?
I think there are 2 radically different case studies of AI. One is TeamShares, the other one is Bend & Spoons. I've written 3 articles on Bend & Spoons, and I think I could probably write 3 more, and people are still going to read them because everybody wants to talk about this. And bending spoons is almost like the anti-roll-up, because the idea behind many of the roll-ups is that you go after smaller acquisitions, you don't integrate them, or you integrate them a little bit, and you really go after growing businesses, and they've gone after progressive larger companies, take privates, aggressively reduce headcount, rebuild the tech stack. And, they've been very successful. The company IPO'd at a 20 plus billion valuation. The stock shot up by 41% on the first day. It's come down a little bit, at least at the time of our interview now, but it still remains a sort of wild story of success, where the company is valued at multiple of what the investors have put in. Team shares, on the other hand, which I've also written about, remains a more cautionary tale, where the initial premise was very different. The premise was to buy very small businesses, $500,000 in EBITDA, and really just change their tech stack with an internal product, right? So the idea was that, any middle America business uses accountancies, uses, banking apps. And so the idea was to insource those cost items and make them revenue streams, essentially. And that strategy fell down for two reasons. I think one is because they've not been very selective on buying businesses. So they've bought a number of businesses who just haven't had the defensive characteristics. And secondly, in a place like the United States in particular, where I would argue that the financial software market is very competitive, it's very difficult to argue that one should use, an internal solution. And here again, I would contrast with the Dwelly example, where, if Dwelly software is genuinely superior to what's out in the market, why wouldn't the market use this? But in general, I would say every single conversation that I have with a serial acquirer revolves around AI when people can do. Maybe one cautionary tale to those of our VC listeners or founders of AI-backed kind of roll-ups: don't assume that no one else is using AI, right? I see this particularly in property management market, which is obviously infested with private equity firms. Don't assume that private equity-backed roll-ups don't have their own software. Don't assume that they're not trying to aggressively kind of grow margins, because at the end of the day, private equity firms will have vastly more firepower than you. And if you at one point in time run out of money because you've been using some of it to most of the money to build your product, they still have bullets. So you don't want to be in a shutout when your gun is jammed, you have no bullets, and the guys have a lot of bullets. Just be thoughtful, and before you decide that the industry is ready for VC-backed AI disruption, just talk around the community what everyone else is doing.
Wow, that's a really interesting take. I'm going to zoom out here now and go back to roll-ups and aspiring operators. For anyone that's listening and they're thinking of doing their own roll-up and they want to build relationships with the right investors and partners, what actually works and what gets you ignored? And before you answer, I know one thing that works really well, and that's going to any of RollUpEurope's events. That has been fantastic for me. So that's my recommendation, but I'll pass it over to you, Alex.
Yeah, look, I've been surprised by the responsiveness of the community. I was talking to a debt fund just a couple of days ago, and he told me about a deal that he landed just by writing to the protagonist of one of our articles. I was actually very surprised. So in general, in this community, people are very kind of responsive. So I would say going to events, being prepared, reading about who else is there, and just doing your homework is very helpful. That's number one. I think number two is probably researching the space and figuring out who are the investors that you want to hang out with and what are the industries that you want to go after. Because something that I'm seeing more and more is that there are local clubs appearing. As usual, search founders and VCs have mobilized the first. And so, I was talking to this founder of a Polish AI roll-up the other day, and he mentioned, we have a WhatsApp group of 30 other AI roll-ups in Poland. So clearly that exists. But, in terms of what works, yes, I think in person is always the best. Year to date, we've done events in London, Munich, New York, Milan, Zurich. In September, we're going to do another one in London. So 24th of September is, please save the date. And then we'll do one in Warsaw on the 15th of October, and then Paris and maybe Berlin at the end of the year. So we want to do as many cities as possible.
I would agree with you that in this space, it's been surprising to me actually, because I haven't come from a finance background, and just how receptive everyone is. And I've been thinking about this, like, why is everyone being open to having more conversations? And I think naturally, if you're within this world within this space, then you're probably somewhat opportunistic. You're always looking for new opportunities where you could either invest or learn from people. And so every time I might drop a LinkedIn message to someone, it's very often that I'll get received and people ask for a call or introductions will happen around me. So yeah, I agree that like that's been a very positive experience of mine within this space. So moving on to the next question. What are the most common ways that you see roll-ups fall apart once the deals are done? You mentioned earlier it is often a lot to do with just actually buying turnaround cases or sort of buying companies that you think that you could do a lot better than a founder. Is there any other examples?
Yes, number 2 would be unproven teams, and number 3 would be different expectations regarding the exit or regarding the roles. So roll-ups are a bit like families. I'm 40, a lot of families start falling apart because people realize by that age that their approach to child rearing or just to managing relationships is different. And so a number of investors will have this rule that they don't want solo founders because the risk is too much. But also when it comes down to duos, they don't want people who haven't known each other for a long enough time because ultimately it's very stressful. You're integrating lots of small businesses. And you may end up in a situation where the person just isn't ready for it. So I see a lot of preference for it's not necessarily somebody that you work with on a day-to-day basis, but I increasingly see people reconnecting after 5 or 10 years apart. They have these prior relationships and they really come together as a team. And I think having people with different skill set and different personalities also helps, because if I think about some of the most successful buy and builds in Europe that have delivered outsized returns, the founders really tend to complement each other in a way that one person is a consummate deal maker, very good just originating deals, and the other person is more thoughtful around operations. What do we improve? And especially if you plan to change the whole operating stack, it's great to have a good product. It's great to have AI. It's great to have software, but somebody needs to go out there and talk to the workers in the field and convince them to use this technology. And if you're not that person, if you're not able to talk to people without just shouting orders, you're not going to get it done.
That's really interesting. On the last episode, we had Nicholas DePorter from Strada, and he was saying that they always prefer duos. That is their go-to. It doesn't have to be. They make exceptions at times, but it's very much preferred. So if someone's listening that is an aspiring roll-up operator and they don't have a co-founder that they could build this with, what are some ways that they could, because I can imagine it's quite complicated, because if your career, you've been in investment banking, for example, like your case, you're probably not hanging out with that many operators or domain experts even. Maybe if you want to do an air conditioning roll-up, you might not know so many air conditioning senior people. So what are some ways that you recommend to find potential co-founders?
Well, you mentioned Strata. I'm a huge fan of Strata. I think what they've done with Elevate program is amazing, because they took the best practices from the search fund community and then in the venture community and applied it to buy and build. So definitely come into Strata organized events like the one we did in Milan a couple of weeks ago. Come into RollUpEurope events is great. I recommend our bootcamp as well. But also I would just go out there and talk to the people already in that industry. So for example, if you have a finance background and you're interested about industry XYZ, figure out who are the best performing companies. Because what tends to happen in some of the standout acquirers like Halma in the UK is that over time people, like Halma's share price has gone multiple times, right? But a lot of the times people that work in those serial acquirers, they don't necessarily benefit directly from that share price. And so, but they see the playbook, they understand it. So maybe you should go and talk to them. Maybe if you, as you mentioned, admire HVAC rollups, okay, go look up what are some of the best HVAC rollups, go talk to the operators and just plant that seed. Because conversely, people who are very good at running those businesses, maybe they don't have that acquisition capability. So I would argue people to have more conversations, but informed conversations where you come with a true intent and you're very specific about what you want to achieve.
Yeah, that makes sense. And just, I read this book called Go Do Deals by Jeremy Harbour. And one thing that's within the book that I found interesting, at least, was just see every potential conversation as something that could be a future investment case or partnership. And if you're interested in, for example, HVAC, maybe go to trade shows and meet some of the owners of the businesses there. And that relationship, maybe after 5 years, could lead to something that you wouldn't have expected. So don't stay in your own little bubble.
It's very true. And I would add to this is that I think when it comes down to building a deal flow in particular, there is a lot of worship of this proprietary. Like you said, go to trade shows and talk to the people, and that's great. The problem with proprietary takes a very long time. So as you said, if you have 5 years, by all means do it. But many of us, we have a clock ticking and we don't have 5 years. And I would say, talk to the brokers, talk to the accountants. I see a bit of a disdain from people from some of the more prestige banks and private equity firms that are coming out, and they don't want to talk to those brokers. But this is the industry. The brokers are the gatekeepers. They have people to sell this to, and they have a lot of domain expertise. So being nice to those advisors and position yourself as a credible buyer is super helpful to you.
Yeah, so go to sell-side brokers, explain what you're interested in doing, get connected to maybe someone that could become a co-founder with you on a roll-up play. Yeah, that makes a lot of sense. We're nearly at the end of the podcast, but we have this question that I like to ask to everyone on the podcast, which is, what's a popular opinion in the roll-up or PE world that you think is wrong?
Yeah, I thought about this very long and hard before our podcast. And I think the popular opinion is that you necessarily need to have private equity experience to be successful in this game. I think it's wrong. Because I think people tend to focus on one very tiny subset of the industry, which is buy and build, which I would argue do require M&A and investment expertise, where you buy companies quickly, you do some level of integration, and on day one, you know who you're going to sell this to. That I agree. But at the same time, there's also holding companies. There's other forms where, in fact, I think a lot of what's been taught by private equity is actually not helpful at all, because it's all about autonomy and decentralization and giving people a lot more freedom. So many people get discouraged from pursuing their thesis just because they don't have it. And I would say that's just wrong. You can be successful without that. Just make sure that you find the right niche.
Really, really motivational, actually. I can imagine so many people come in and feel a bit overwhelmed or out of place when most people do have a finance background, or at least a PE background. So that's it makes a lot of sense what you're saying. And the last question is, who do you think is doing interesting work in this space right now? Someone you'd want to hear from on a podcast like this?
Well, I think you should have Builders Associate on your podcast. Either Marwan or Sean Ree, or if you can get both of them, definitely. I think the very driven people, they had a successful exit, actually several successful exits. They are not stopping. They heavily invest in the community. And so, you should interview them.
Okay, thank you for that. And if anyone wants to get in contact with you, what's the best way? Is it through LinkedIn or email?
Well, I think to everyone who reaches out to me and tell me that they're big fans of RollUpEurope, the first thing I do is check out their opening stats in the newsletter. So if you're reading the newsletter, it's the biggest and deepest form of praise you can have. So if you're not on our mailing list, chances of me talking to you are very low, because I need to know that you care about the product. Otherwise, it's alex@RollUpEurope.com. You see me and my team, my co-founders around Europe. So very, very reachable.
Fantastic. Alex, thank you so much for coming on to this episode. It has been extremely interesting to hear your insights. Really appreciate it.
My pleasure. Thank you, Dylan.